All right, now let us start the remaining part of our chapter number 9. So here we are going to first calculate our additional financing need based on the self-supporting growth rate formula we know. So we just manipulated the formula to get the additional financing need. So here you need to know you required increase in assets, then increase in spontaneous liabilities, and then increase in retained earnings. And here you can see the formula to get each of those, and then you're going to get your additional financing need. All right, so first let us calculate the factors we need to know to get our additional financing need. First of all, sales for the most recent year. Next, sales for the next year. So remember our sales growth rate in the year 2022 was 10%. So we just applied the growth rate. Then forecasted increase in the sales growth is $500 million. And then most recent years operating assets. So here, operating assets do not include investments because those are not related to your day-to-day operation. So we are going to reduce our total assets in the year 2021 by the investment amounts. So here we just have short-term investment, but you may have long-term investment too. So you are going to reduce your total assets by the investment amounts which are not related to your day-to-day operation to get you operating assets. Next, we are going to calculate our required operating assets per dollar of sales revenue. Next, most recent years is spontaneous liabilities. So in spontaneous liabilities include all the current liabilities accounts except for the debt accounts. Next, spontaneous liabilities per dollar of sales revenue. And then net profit margin here. So your net profit margin, net income over sales. So your net income over sales. Next, your dividend as percentage of net income. So here, your dividend as percentage of net income. Actually, it should be common dividend as percentage of net income after preferred stock. Next, now let us calculate our required increase in sales. So it is our operating assets to sales ratio times our dollar sales growth. So here, our operating assets to sales ratio, and then this one is our dollar sales increase. Next, our spontaneous liabilities to sales ratio, and then our growth in sales. Next, so this is your current year sales amount, then your profit margin, and then your dividend payout ratio. So current year sales then times profit margin times 1 minus dividend payout ratio. Now additional financing need. So additional financing need is equal to required increase in assets minus the financing get from spontaneous liabilities, the financing you get from internal financing. Enter. So your additional financing need here is 93.20. All right. Next, your self-supporting growth rate. So for self-supporting growth rate, it is your profit margin. So your profit margin times your dividend pay, 1 minus dividend payout ratio, 1 minus dividend payout ratio times your sales in the recent years. Next, your operating assets minus operating liabilities. So operating assets minus your operating spontaneous liabilities or operating liabilities minus then profit margin times 1 minus dividend payout ratio. So profit margin times 1 minus dividend payout ratio times your current year sales. Next, your sustainable growth rate. So your sustainable growth rate here is 6.7%. So this is the growth rate you can sustain without relying on any additional financing needed. Now, in this case, remember your sales growth rate is 10%, whereas your sustainable growth rate is 6.7%. So based on our argument, we can say you actually need additional financing. All right, now we are gonna find the sensitivity of our sales to two different factors. One is sales growth rate, another one is our cost of goods sold as percentage of sales. So here you can see our expected growth rate, sales growth rate in the year 2022 is 8%, whereas our cost of goods sold as percentage of sales is expected to be 78%. Now we are gonna see the sensitivity of our net income with the changes in this, with the changes in these two factors. So what we are gonna do first is we are gonna first. So the way we actually do it is this, and remember, you can do it for anything you want. So here, I want to see the sensitivity of cost of goods, so sensitivity of net income to sales growth rate and cost of goods sold as percentage of sales. So what I'm gonna do first, I'm gonna first copy this sales growth rate I actually used in my assumption, which is 10%. So let me just copy it. And then I'm gonna put it in the middle column here, 10%. Then I'm gonna just reduce it by 1% to the left cells, you can see, and then I'm going to increase it by 1% to the right cells. Next, I'm going to copy the cost of goods sold as percentage of sales from my assumption. So here you can see cost of goods sold as percentage of sales is expected to be 78%. And again, I'm going to put it on the middle column. And then this is a very big number and very sensitive. I mean, our net income is very sensitive to the changes of this one. So we are going to increase it by 0.5% as we go down from our base rate. And then we are going to reduce our base rate by 0.5% as we go up from our base cell. All right. Now you can see at the intersection of our row and column, we have one cell open. So here we are going to actually link the cell for which we are going to actually estimate the sensitivity, right? So here we are going to actually estimate the sensitivity of net income. So we just selected, that particular one, but that particular cell. So we now linked it to our sensitivity table. Now select the entire table area, then go to the data section. From there, what if, then data table. Now here our row is what? Our sales growth. So select it from our assumption section. So 10%. And our column here is what? Cost of goods sold as percentage of sales. So you just link those two cells from the assumption section, which you apply to actually estimate your pro forma financial statement. Now hit OK. Then go up and check the table. Now you can see. Oh, we did something wrong. So let's see this. Okay. We did something wrong. Let us do it one more time. Choose the entire area, then what if scenario data table, and then row input. Okay. All right. So choose it from here, 10%, and then 78%. Hit OK. Let us check if we get it right now. So here, okay, there must be something wrong. Let me figure it out. Okay, copy. I'm going to make them text the same way. Copy, and I'm going to make them text. Now I'm going to try it again. So remember, this one is linked. Then this, what if analysis, data table on 10%, 78%. Hit OK. Go all the way up. All right, let me figure it out. Right, let us start from the very beginning for this sensitivity test. So as I said, we're gonna first copy our sales growth rate. It could be anything. Remember, here we are now doing it with respect to sales growth rate and cost of goods sold as percentage of sales. So we know here our sales growth rate is 10%. Put it on the middle column, and then increase it by 1% or whatever you want to see. here. So I want to see the sensitivity of my net income for the sales growth rate in the range of point, uh, 0.08 to 0.12. That means for the sales growth rate of 8% to 12%. The same way, copy your cost of goods sold as percentage of sales you expect to happen in the year 2022, and then just put the range as you want. In my case, I want to see the sensitivity of my net income to the cost of goods sold in the as percentage of sales in the range of 77% to 79%. Now, remember, these assumptions are for the year 2022. So let us also link here the net income we estimated for the year 2022. So our net income estimated for the year 2022 is 275. So we linked it, right? So remember, this is the only linked cell. Everything else here are text. So this one, I mean, this should be text. That means they are just numbers. Only this one is linked, right? To our financial statement forecasted. Then here, data, what if analysis, data table. Now, select your assumption. So your growth assumption here is 10%, which you put on your row, and then your assumption for cost of goods sold as percentage of sales was 78%, which you put on your column. So I put it as a column input, then hit OK. Now you see. So whenever your sales growth rate was 10% and then cost of goods sold as percentage of sales is 78%, then your estimated net income was 275%. Now you can see, as sales growth rate increases, your net income increases. On the other hand, as cost of goods sold as percentage of sales increases, your net income decreases. Now here you can see your net income in this particular sensitivity table ranges from 228.5 million to 323 million dollars. So you expect your net sales growth rate to be in this bracket. All right, now let us do the simulation test. So here, first of all, your expected net income. So your expected net income for the year 2022 is $275, and then standard deviation. So let us calculate the standard deviation of our net income from the sensitivity table. $30. Then first simulation. So here our assumption is our net income is normally distributed. And then for probability, we want it to be randomly distributed, rand, and then mean value, and then standard deviation. Hit enter. Next, now you need to know how many trials you're going to run. So here you can see I'm going to run actually 1,000 trials. So for the very first one, choose your first simulated amount, 270. Next, just select the entire table. You can see here. Then from data, go to goal seek. Then from data table, you don't have any row here. You just have column, right? So on the column cell, just select any blank cell you have. So here I choose this one. Then hit OK. Now you can see these are the simulated net income you have. Now you can calculate the mean of your simulated net income and then standard deviation of your simulated net income, but that one is determined. We want the mean and standard deviation to be 75 and 30, as you can see, somewhat around that. Now, based on the assumption that your net income is normally distributed and standard deviation is equal to 30, then your simulation test shows that the minimum and maximum value of your net income will be in the range of 180 million to 368 million. So these are simulation tests for our net income. We can do the exact same test for our price per share, total assets we forecasted for the year 2022 or any other year, and then our total free cash flow to the firm, anything. So we are going to just follow the exact same approach. All right, that's all from the chapter. Thank you.